Ladies and gentlemen, good day and welcome to the Canfin Homes Limited Q2FY23 earnings conference call hosted by Investec Capital Services. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Nidesh from Investec Capital Services. Thank you and over to you.
Thank you, Mike. Good afternoon, everyone. Welcome to the Q2FY23 earnings call of Canfin Homes Limited. To discuss the financial performance of Canfin Homes and to address your queries, we have with us today Mr. Girish Kousgi, MD and CEO of Canfin Homes, Mr. Amitabh Chatterjee, Deputy Managing Director, Ms. Shamila, Business Head, and Mr. Prashant Joshi, CFO of Canfin Homes Limited. I would now like to hand over the call to Mr. Kousgi for his opening comments. Over to you, sir.
Good afternoon to all the investors and welcome to the earnings call. It's been a fruitful quarter, a very good quarter, I must say, because we've done well on almost all the key parameters. If we look at book, we have grown by 22%. And if I have to talk about disbursement, even sequentially we have grown by about 2%. And if I have to compare on a YOY basis, it is marginal growth. That's only because last year quarter one there was COVID, and therefore we couldn't disburse much. So there was a spillover effect, and last year quarter two we did very well. We did about 2,208 crores. And this quarter we have done 2,245 crores. So if I have to compare YOY quarter, I think there has been a marginal increase. And if I have to talk about revenue, on a quarterly YOY we have grown at 40% and half yearly 38%, operating profit 33%, and if I have to compare H1 and H1, 37%. There is a growth of PAT by 15%. If I have to compare half yearly, it's 31% over last year. So NIM has been pretty stable at about 3.55%. There has been a 5 bps drop in NIM, and spread is 2.51, drop from 2.66. So I had indicated earlier, on a steady state, we'll be able to maintain 3 and 2.4, even though we are at 3.55 NIM and 2.51 spread. We will be able to maintain 3.5 and 2.5 for next few quarters. But in the long run, I think it will somewhere settle down around 3% NIM and 2.4% of spread. I think in last few quarters, there has been increase in the cost, and especially for last quarter, the cost went up from 5.8 to 6.04. So there has been increase in cost by about 24 bps. And the last quarter the yield was 8.46%, which improved to 8.55%. Incremental yield is about 9.02 and incremental cost is 6.48. Our portfolio yield, as I mentioned, is about 8.55. And if we have to look at asset quality, it improved. Last quarter was 0.65. This quarter is 0.62. Net NPA on a like-to-like basis, apple-to-apple comparison, last quarter was 0.3. This is under IRAC, and under IRAC this quarter it is 0.28. What has happened is that we have moved to ECL model. We have migrated to ECL model, and therefore there has been a rearrangement within the total provision between NPA and standard. So we have withdrawn 21 crores from NPA. And that is now sitting in standard provisioning. So total standard provisioning is about 33.5 crores. Out of 33.5 crores, 21 crores is something which has moved from NPA. And that is why you will see net NPA increase from 0.3 to 0.35. So 0.3, what we are referring to last quarter is IRAC. Equal comparison now is 0.28. Under ECL, it is 0.35. And therefore, we see that the net NPA has gone up and the PCR has come down. It's only an internal adjustment because of migration. If you have to look at total slippage, it is 1 crore net slippage because we have I think 12 crores is the slippage, and we have recovered 13 crores. And therefore, you will see there asset quality and the slippages being pretty okay. In terms of credit cost, it is 0.04%. Demand is pretty good. We are seeing this across all geography, all segments. We are seeing this, amongst all the products. In terms of salaried and self-employed, we see salaried to be driving a better growth compared to self-employed non-professional. Self-employed non-professional has improved. It's improving every quarter. But I think another quarter or two, I think it will be back to 30% incrementally. Otherwise, we see good momentum across, in spite of interest rate hike, and also in spite of cost of construction going up. There has been, on an average, in some markets, 10 to 12% increase in the property prices, especially on the apartment side. And construction, the cost has gone up by 6 to 7%. In spite of this increase, we are seeing a robust growth. This is a quick brief on what happened in quarter two. We'll be happy to engage, because I'm sure there'll be a lot of questions, because we have moved from IRAC to ECL. There'll be a lot of questions, so I'll be happy to take any questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. We have the first question from the line of Dhaval from DSP. Please go ahead.
Hi sir. Thanks for the opportunity. I had 3 questions. First one is relating to the borrowings. So, in the last 6 quarters, we've sort of seen commercial papers share in the borrowing mix come down from 18-19% to about 8%. Incrementally, what is your thought process on the overall borrowing mix, and specifically for CPs, if you could give some perspective? So that's question number 1. The second question is relating to spreads. So we've seen some moderation in spreads this quarter. Just if you could give, I know you've given a medium-term guidance of spread, but just directionally, would you expect next couple of quarters, to be more similar, in the similar zone as we've seen in the second quarter, or there is, further pressure likely? Some perspective on that would be useful. And the last question is relating to the provisioning change. Could you provide the stock of standard asset provisioning and any other provisioning, be it restructuring provision, etc.? So some perspective on the entire provision bit. That would be the third question. Also the restructured book number. Yeah. Thanks.
Yeah, sure. On the borrowing mix, we don't see too much of a change from the current mix in the near term. CP rates are going because the overall rates are going up, and which will also, we can see a higher rate on NCDs. So we are seeing increase in rates across, be it term loan from banks, be it bonds, or CP. So what we will do is, this is very, very dynamic. So we are agnostic in terms of the source beyond regulatory requirement. And therefore, we'll be very, very watchful, because our endeavor is to keep the cost of funds low. So to that extent, we will be quite conscious about getting the right mix at the right cost. Having said that, I think we will not be able to see too much of a change in the next couple of quarters. So borrowing mix will be almost, for example, today we have, from bank 54%, as a mix. So that 54 maybe can become to a 52. but it will not become 45. So there will be a small change here and there. Otherwise, not much of change in the mix. In terms of margin, yes, we did increase rates, in last 1 year. One thing is very sure, we have given guidance for long term, that is 3% NIM and 2.4% spread. So that definitely we will protect. How we will do is, depending on the cost of funds, we will try to increase the yield so that we get the right margin and profitability. But having said that, in the near term, I think it will be somewhere around 3.5 and 2.5. This would continue for next couple of quarters. But in the long run, it will be about 3, 2.4. This is more to do because of our profile. As a Canfin, we are completely into retail, affordable, low ticket. So we are not into high value, we are not into non-home, we are not into builder funding, we are not into corporate funding. And therefore, the ability of the portfolio to generate higher yield is limited to that extent. And therefore, we want to moderate in the long term our NIM at 3 and spread at 2.4. With respect to provisioning, Joshi will give the details.
Yeah, regarding the NPA provisioning, in fact, I am getting a lot of calls also. I thought give a detailed explanation. The provisioning requirement to be maintained as per the RBI or NHB direction is IRAC norms or ECL model, whichever was higher. Till last quarter, it was the IRAC norms which was higher. Because in the ECL model, the standard asset attacks the provisioning at a higher rate compared to the IRAC norms on account of PD, LGD and non-recovery percentage. In June, the provisioning what we disclosed is 97.85 crores for NPA, 10.17 crores for standard asset. Put together, it is 199.02 crores. This is the provisioning held in the books as of June 30th, 2022. Now, when we do that calculation, we do the calculation as per the ECL model also. The ECL model provisioning at that time was put somewhere around 184 crores. The gap was to the extent of around 15 crores. During this quarter, we have disbursed 2,245 crores. The full amount is the standard asset, which requires the provisioning at the rate of standard asset provisioning as per the ECL model. So on account of increased disbursement, the ECL model provisioning stood at 208.86 crores, whereas the IRAC provisioning stood at 204.83 crores. See, now the scenario has changed. ECL model has become more and IRAC has come down. So company has to hold the provisioning whichever is higher. So we have to migrate to the ECL model. On account of that, the provisioning required for NPA as per the ECL model comes to 77.53 crores, which was 97.85 crores in June. So that means the provision has been come down by 20.31 crores. Whereas as per the standard asset provisioning, which is required to be maintained, comes to 131.33 against what we held 101.17 crores. That means there is a difference of 30.16 crores which we have to provide. Further, for undisbursed line of credit, we too have to provide as per the ECL model, which comes to 3.38 crores. So on account of this, during the quarter, there was a withdrawal of provisioning on NPA to the extent of 20.31 and creation of additional provisioning in respect of standard asset to the extent of 33.55. So with this, the total provisioning held in the books will be 131.33 for the standard asset, 77.53 is for the NPA, put together is 208.86. Apart from them, restructured for provision we are holding in the books to the extent of 67 crores. So total provision in the books as on date stood at 279.94 crores. This is the total provisioning movement. Because we are getting the repeated calls, I thought this is the right opportunity to explain everything in detail. So most of the repeated calls can be cleared it off. Thank you.
And the stock of standard restructured book?
These have been disclosed in the SEBI result. It is 704.85 crores. It is there in the SEBI result, second page notes, point number 6.
Thank you, sir. All the best. I'll come back.
Also, Joshi, please share the original amount of 709 crores. What is that outstanding today? Because this will be with interest as well.
Outstanding.
Correct.
No. The original amount outstanding also you share.
Yeah, it was 694 at that time.
Now it is how much?
708.95. Out of it,
This is the operator. Can you hear us in the call, the management?
So from the initial restructured book, close to about 62 crores have been closed. Now the 704.85 includes interest accrual. So which means out of the original book, 60 crores worth of loans are closed already.
So the outstanding is 645 crore approximately?
So from the original amount, because in what happens in restructured accounts, so there will be interest accrual, right? So this 704.85 includes interest accrual, but the pause of this is that is 709 minus 62. That is the actual pause.
Understood, sir. Thank you. All the best.
Thank you. So it's about 647 crores. Outstanding is 647. With interest, it is 705.
Thank you. We have the next question from the line of Harsha from L&T Mutual Fund. Please go ahead.
Yeah, thank you for the opportunity. So just a couple of questions. One, you mentioned a long-term NIM guidance of around 3%. Just two questions on that. Currently, we are at 3.55, and for this year, we are guiding for 3.5. First, what are the levers to maintain that NIM? And once we come down to 3% on an average, plus minus 10 basis point, what are the levers that we will have at that time to maintain our ROA at 2%? Because our credit cost is also lower. Our total cost as a percentage of asset is also not inched up significantly. So at 3% NIM, will we be able to do 2% ROA?
See, our guidance on margin in the long run is about 3% and not in the near future, for the simple reason, I think once we grow on a larger base, showing growth will be difficult, but still we want to maintain that growth level, and therefore there it will be a trade-off between growth and margins. The margins, the threshold would be 3 and 2.4. Right. Now, having said that, we will also figure out avenues where we can try and increase our NIM, but we don't want to tell that at this point in time because it's very, very dynamic. I'm not getting into the ratios. All I'm saying is that our growth in terms of disbursement and book will be 18 to 20%. In terms of margins, it will be 3 and 2.4. In the near term, 3.5 and 2.5. So I know whether we'll be able to maintain ROA of 2. I think all those things I will leave it to the investors. We can also work out on that. But at this point in time, we are confident of because for us margin is more a function of what is the profitability that we need to maintain, and it depends on the cost. So depending on the cost of funds, we would moderate the yield. So today we are at a particular yield because that is the decision point. And if you have to improve yield on portfolio A, B on incrementally also, that we can try and do. So it is something which is in our control. It's only a decision point from when we want to trigger that action. So wherever, just to cut short the answer, if you have to maintain profitability and the return ratios, we can always moderate the yield and ensure that we show a higher profit. We show higher margins. So it's an action point. When we reach that time, then we will trigger the action.
So when you say moderate yield, what do you mean by that?
Moderate yield is increase or decrease in yield. So for example,
there is a flexibility you are saying.
Exactly, yeah. So for example, today we are at yield of let's say 8.55 now, and let's say over next few quarters, if you have to increase yield to show better margins, so we will also try and build book at a higher rate, and also on the portfolio depending on the increase in the overall interest rate in the market.
So, sir, that change in yield, does that require you to lend to a new set of borrowers, means whom you are not, that does not classify under your current set of borrowers, or is it the existing borrowers where you will increase the rate, or is it a mix?
Yeah, whatever we have discussed till now and what we'll be discussing in this call will be based on no change in profile or the segment. There is no change in policy, no change in product, no change in profile, no change in segment, no change at all. The only change is going to be today we are 100% retail. What we are discussing now going forward will be 99.5% retail and 0.5% would be builder funding. So that we are experimenting now with very small ticket size. So, but for the small change of builder funding up to 0.5% over a period of next 3 years, there will be no change in strategy whatsoever.
Understood, sir. And just a second question to the rest of the team also. Where are we in terms of hiring the new CEO? Are we at a preliminary stage? Have we shortlisted? Are we at an advanced stage? Where are we?
See, we have already given the task to headhunting agency, and we are in the process. Shortlisting has begun, so we expect interviews to take place shortly. Depending upon which candidate is selected, we expect that whoever is selected will be needing some time. By that estimate, we estimate that around maybe new MD and CEO will be able to join at the end of this quarter.
Okay, so before the end of the calendar year.
Yeah.
Understood, sir. Okay, sir, that's it from my side. Thank you and all the best.
Thank you. We have the next question from the line of Punit Mittal from Global Core Capital HK Limited. Please go ahead.
Hi, can you hear me?
Yes, we can.
Hi, just one question. One observation, and if you can comment on it. When the news of the resignation of the MD came out, the stock price started falling way before the official announcement came out on the exchanges. So naturally, this information was passed on externally before the material in the news was published on the exchanges. Has the company looked into it of why that happened and who's responsible for that, or has the company not observed any such thing?
See, as far as we are aware, we have maintained complete confidentiality till such time we reported to the exchanges, right? So I think as far as we know from the company management side, I think there has been no lapse on managing this entire resignation process.
Okay. Thank you very much.
Thank you. We have the next question from the line of Shripal Doshi from Equirus. Please go ahead.
Hi, sir, and congrats for the strong growth that we delivered during the quarter. So just one clarification on the outstanding standard restructured book. You said that is 647 crore, on which we are carrying a provision of 67 crore. Is that right?
Yeah.
Okay. And sir, with respect to the ECL norms, would we be going forward? Would we be disclosing the stage 1, 2, 3 and the coverage on the same? Or if you could share currently, it would be very helpful.
The disclosure will be as per the RBI guidelines what we are required to disclose. The same format is maintained.
Okay. And so on the yield side, have we taken any rate hike during the quarter? Any changes on the rec rates?
In quarter 2, we haven't increased because we had increased in quarter 1.
Okay. And so going ahead, are we planning to increase it in the next quarter?
This quarter we are planning to.
It would be by how many basis points?
That we have not decided because last quarter, I think just before quarter 2 could begin, we had discussed, in our internal meetings and dashboard, we decided that we should not immediately increase because we were pretty comfortable, on the yield spread and the overall margin, and therefore we didn't increase the rates. So this quarter we plan to increase, and it will be marginal because even now we are pretty comfortable on the margin.
Okay, got it. So one last question. It is with respect to the Chief Risk Officer. So I think there was a filing wherein Mr. Uttaya Kumar was designated as the interim CRO. So because I think there was a superannuation of Mr. Narendra, I suppose. So are we in process of finding a replacement for that position as well?
Yes, we are in the process of hiring CRO, and that process is already on, and we have shortlisted few candidates, and we have to see when who is going to join.
Okay. So there is also, is there any update that is there for the CFO position?
It is the same thing with CFO also. Same holds true for the CFO also.
Got it, sir. Thank you, sir. Thank you so much for answering my questions, and good luck for the next quarter.
Thanks.
Thank you. We have the next question from the line of Ratik Gupta from Guardian Asset Management. Please go ahead.
Yeah. Hi, sir. So I wanted to understand the relation between the average business per branch and the employee. What I see is there has been a decrease in your average business per branch for this quarter as against the previous quarter, while there has been an increase in the average business per employee. And also we are seeing a decrease in the employee expense for this quarter in a significant as compared to the previous one. So can you give a limelight on that?
Regarding the employee expenses, last quarter was 22 crores, this quarter it is 17.83, mainly on account of actual valuation, that is as per accounting standard 15, where we have to make the provision if the valuation of the investments are less than the committed. Now, as we are aware, the GSEC valuation has gone up this quarter, so the provisioning, what is required, has been come down. Last quarter, that is Q1, we made a provision to the extent of around 4.5 crores for the AS 15, considering of PL encashment, sick leave and gratuity expenses. That is why it has come to 22 crores, but for which it was hanging around 16.8 crores. This year it is 17.8 crores with the additional provisioning of 0.51 crore or 51 lakhs, what is mandated for AS 15, but for which it is 16.87. Employee cost almost remained the same as such.
In terms of income, average business per employee, last quarter was 30.87, and now it is 30. This is a marginal increase.
Yeah. But there has been also a decrease in the average business per branch. So, I mean, what we can see is there
we opened 4 new branches. So there is no difference in the branch count as well, but for 4.
Okay. And my second question is on the borrowing going forward. Are we looking to increase our deposits or how is it? And if you can give me interest-wise on what is the average interest rate that you're carrying for market borrowings and the CP papers?
See, in terms of deposit, of course, definitely we are keen on increasing a deposit base, but that also depends on what is the additional cost burden we are willing to take in our cost structure. Because as of now, the cost of raising deposits is much higher than many other sources. So having said this, a long-term strategy would be to try and increase the deposit base. Near term, it depends on how well it will fit into a cost structure.
Okay. And can you give me the average interest, the rate you're carrying for market borrowing and the CP?
Market borrowing is below 5%.
Okay.
So as of now, and the deposit cost is higher than the average borrowing cost of the company.
Okay. Yeah. Thank you, sir.
Thank you. We have the next question from the line of Rishabh Dugar from CD Equisearch. Please go ahead.
Good afternoon. So I want to understand what is your competitive advantage in lending compared to banks and other housing finance companies?
Okay. So today if you look at market is quite large. Now there are set of institutions which are building book at 8%, even less than 8%, and some at 9, some at 11, some at even 14-15%. Okay. Now if you see, there will be slight difference in the profile, and there will be slight difference in the nature of property, and there will be slight difference in the geography in which they operate. So we are in between. We are not as competitive as banks by design in terms of pricing, and also we are very competitive compared to the next set of institutions which are building book at a higher yield. So this market gives scope for institutions to operate at different yields, depending on the risk appetite of each institution. So if you have to, so for example, we will have overlap in terms of business with PSU banks, with private banks, with HFCs, with NBFCs. At the same time, we'll also have within HFCs there are different categories of HFCs, broadly categorizing based on the yield at which they build the portfolio. So we are in between. So we have that advantage of moderating. If we want to grow our book, now we can be little competitive on pricing and slightly better a profile and grow. At the same time, if you want to balance and increase our margins and profitability, assuming we have enough and more growth coming in, then we can probably try and build book at a higher portfolio. So just to answer your question in short, I think market is quite robust. It's huge, and therefore there is opportunity for all types of institutions to build book at different yield levels. So we are, as of now, somewhere in between.
Okay, so you talked about that there is opportunity for all yield levels, but I just want to understand that how much do you think these things matter when money per se is a commodity and whoever lends competitively gets the business?
It actually depends on the risk appetite. So for example, today banks, they have cost of funds advantage, and therefore they go to Cat A builders, Cat A corporates. We don't have cost of fund advantage compared to banks. We have an advantage compared to all the HFCs and NBFCs. Rather, we are the best in the market as of now. So, but we can't really compete with big banks on cost. And therefore, our segment is Cat B builders, Cat C builders. Cat B corporates, Cat C corporates. If you look at set of other institutions, they focus on probably Cat C builders, Cat D builders. So there are different segmentations. So depending on the risk appetite and how well they underwrite and manage the portfolio, they can figure out in which segment they need to operate.
Okay, thank you.
Thank you. We have the next question from the line of Ankit Shah from White Equity. Please go ahead.
Thank you for taking my question. Sir, just one question. What is the collection efficiency in restructured which has become due?
See, in restructured, as I mentioned, now the outstanding is about 647 crores from the original pause of 709. In restructured book, about 21% of customers are paying in advance. Now, out of the cases what has fallen due, not even a single case is in DPD.
All right. That's it. Thank you.
Thank you. We have the next question from the line of Mahek T from Yellow Jersey Investment Advisors. Please go ahead.
Hello. Hey, sir, first of all, congratulations on good set of numbers. Hello.
Yeah, please go ahead. Thank you so much. Sorry, I think small correction. Out of the entire restructured pool, 1 crore is in NPA now. And initially, we had anticipated that 7% of the restructured book, that is approximately 700 crores. So 7% would come to 49 crores. So 49 crores would slip to NPA. And after a couple of quarters, looking at the performance, we moderated that to 5%. That is about 35 crores. Now the outstanding is 650 crores. So we expect in future 5% of 650 crores to move into NPA. That is about 32 crores approximately. We have close to 49 crores which we plan to recover from the existing NPA pool. So as on a net basis, I think our GNP will be still, it will be around 0.6 to 0.65. Yeah, please go ahead.
Okay. Okay, sir. So first of all, are there any plans for for Canara Bank to exit from our company, or do they plan to stay with us for the long term?
As of now, I think bank doesn't have any plan to exit from the company. I think last earnings calls, Canara Bank has clarified they don't have any plans to exit from the company.
Okay. And so how do we look at the growth from here in terms of net disbursement going forward? And comparing ourselves to other companies, how do we place ourselves in the market in terms of the growth journey from here on? Do we plan to have any strategy to capture the market share as such in the affordable housing segment itself?
No, see, we don't chase market share. We have a plan, we have a vision, and we try to execute to reach there. As of now, our plan is to grow at 18-20% for next 3 to 4 years' time. And I think that is well in place, looking at the demand and the way we generate, source, underwrite, and manage the portfolio. So we are right up there. So we generally don't focus on market share, but we focus on we need to double in next 4 years, and therefore what should be the growth rate, and therefore what should be the internal enablements that we need to be ready with to try and achieve that growth rate. So growth story is very much there. We will grow. Our focus is on growth. We will grow. At the same time, maintain profitability, keeping the risk fabric unaltered, which means GNPA will be very much under control, of course, with high liquidity.
Okay, and sir, you mentioned that you are trying your hands with builder finance with a small ticket size, of course. If this works fine, like in what time journey, like in how much time will you be able to comment if this worked in favor or not? And if it works fine, does the company plan to increase the exposure in this particular direction as well?
So actually, we were funding to builders a few years back. So it's not that we are new to this segment. We were, but of course that was few years back. And this might take another, let's say, 12 to 18 months time to have some reasonable exposure, not in terms of percentage, because we never intend to cross 0.5% of the portfolio, at least in next 3 years time. So in next 12 to 18 months time, we might have a very small book. I think then we'll be able to comment, but we don't want to lose out this opportunity. Having said that, we know it's very risky, so we will start very, very small. And this is more of a pilot, I could say. And I think once we are successful in pilot, then we will gradually, probably try and increase, but definitely not more than 0.5% in next 3 years at a portfolio level.
Okay, sir. And sir, like from this quarter's result, we see the interest cost has gone up for us in absolute terms, of course. Is it primarily because we have not passed on the cost to the user, to the customers?
Partly, yes. You're right.
Okay. And what would be the other reason for that?
There has been increase in cost by 24 bits, from 5.8 to 6.04. Now, if we look at the yield, I think yield has gone up only by, 7 or 8 bits.
Okay. Yes, sir. Thank you so much.
Thank you. We have the next question from the line of Sakshi Goenka from Soham Asset Managers. Please go ahead.
Hi, sir. Congrats for the good quarter, and thank you for the opportunity. Hello, am I audible?
Yes, ma'am. Please go ahead. You're audible.
Yeah. Thanks, sir. So just 2 sets of questions. First, if you could tell us what is your rack rate. And secondly, sir, I just wanted to understand your cost of funds. You mentioned that your incremental cost of fund is currently at about 6.48, 6.5%. So if I look at all sorts of borrowing avenues, the 1-year CP or even bank MCLR, they are much, much higher than your incremental cost of funds. I just wanted to understand, is your bank borrowing fixed in the sense it's not linked to MCLR? Because how are you managing such low incremental cost of funds?
Thanks for the question. I think we've been a leader in managing cost for many, many years. You are right, our rack rate is 8.75, and depending on the product, depending on so many other parameters, the rate could be more, because our incremental yield is 9.02. Our rack is 8.75, incremental yield is 9.02, incremental cost is 6.48. At a portfolio level, our yield is 8.55 and cost is 6.04%, which has increased by 20% compared to last quarter. Now, I think I must only thank my team for managing costs very effectively. So we have a very efficient team, and they've been managing this. Having said that, the way we manage cost is that we don't use CP for funding purpose. We use CP as a cost-effective tool to keep the cost lower. Because we feel that generally CP rates would be little lower than other source of borrowing, and therefore we have that arbitrage which we can try and encash. Suppose if CP rates goes up, then we will not avail any CP. So we are agnostic in terms of source as long as we get the right cost, and if it fits into a structure, then we would try and go. And this is beyond the regulatory norms. So, for example, for all the incremental borrowing, 25% has to come in way of NCD. So that irrespective of cost will go and rise. We will also time the issue to keep the cost low. Otherwise, we are agnostic with respect to the source. And that is why we are able to manage our cost better.
So is our bank borrowing linked to MCLR?
See, in fact, almost all, barring some of the borrowings from NHB, which is fixed. Some are fixed for some period and then, of course, it's floating. Otherwise, by and large, all the borrowings are linked to variable. In some way or the other, it could be repo linked, it could be T-bill linked, right? I think in some form or the other, almost all the loans are variable. But for the lending, what we get from NHB, so there we have some portion of fixed.
Understood, sir. Thank you so much.
Thank you.
Thank you. We have the next question from the line of Punit Balani from Nomura. Please go ahead.
Hello.
Please go ahead, sir.
Yeah, just one data keeping question from my side. Can you share the number of, the amount of write-offs for this quarter and for the entire H123?
This quarter is 0. Last quarter is 0. Last 1 year is 0. We have not written off anything at all. Last 1 year is 0. In fact, last 2 years, last 2 years is 0. We were not written off. So it's 0. Last 2 years it's 0. In fact, we have not written off at all.
Okay. Yeah. Okay. Yeah, that's it from my side. Thanks.
Thank you.
Thank you. We have the next question from the line of Anusha Raheja from Dalal and Broacha. Please go ahead.
Yeah, thanks for taking my question. Just one question from my end. Why you are looking for replacement, at the top team? Like you said, there will be replacement for CRO, CFO, and MD and CEO. MD and CEO, we understand, he got a better opportunity, but why at the CRO and CFO level?
See, board has decided, since company is growing, to hire some professionals from the market. So in line with that, it has been decided that CFO and CRO has to be hired from the market.
Apart from that, any other reason?
No, there is absolutely no other reason. All the existing CRO and CFO are the employees of the company since long, and they will remain with the company.
Okay.
Thank you. We have the next question from the line of Shripal Doshi from Equirus. Please go ahead.
Sir, thank you for giving me the opportunity once again. So the question was on yields. So if I look at the calculated yields, and the difference between calculated yields and the reported yields is significant. So the calculated yield comes out to be at close to 9.3% versus your reported yield of 8.6%. So just want you to understand what explains this significant difference here. What all things does come in the base when you calculate it? So just want you to understand it, sir.
No, calculated yield, incremental yield is 9.02%, as we told earlier in the con call. The book yield is at 8.55. So what you told is correct, 9.02 is correct yield, but it is only for the quarter earnings. That means fresh and disbursement what we done is 9.02. And overall is 8.55. That is the book yield.
So in the book, you only take the advances or like, right?
It consists of all advanced housing loans, non-housing loans, yield on our investments and all put together. It is the average yield of each and every loan.
Okay. And so what would be the impact of the investment yield on our overall yield, if you could just give some color for this quarter at least?
Yeah, investment yield will be now almost at par with the slightly higher than our incremental average cost.
Acha, okay. Okay. Okay, sir. Thank you so much. I'll come in the queue if I have more questions, sir. Thank you.
Thank you. We have the next question from the line of Durvish Pujara from Mirabilis Investment. Please go ahead.
Yeah, thanks for the opportunity. So I have two questions. First is on the 4 branches which we expanded in the current quarter. So 3 out of the 4 come from Telangana. So wanted to understand like the thought process there. So like is the market dynamics different there, less bank competition, or what is driving that? And secondly, what is our Telangana geography AUM mix? And also you can state the top 3 states AUM mix. So that's the first question. And second, you already touched upon this, but I am trying to reiterate and understand it better. So in the annual report, we have disclosed the bank-wise borrowing. There we have shown the exposure versus the rate. So if you do a weighted average of that, and if you compare that with the respective bank's MCLR, it is at least 100 to 120 basis point lower. So trying to understand what is making the banks lend us at 100 to 120 basis point lower, and what will make them to continue doing this. So yeah, those are the 2 questions. Thanks.
Okay, so if we look at the entire country, what is working for Canfin well is southern region. So within south, if you see, I think initial days Karnataka was doing really well. Now, along with Karnataka, Telangana is doing very well, which is basically Hyderabad and a few districts, right? And therefore, of course, even TN1, inter-TN is doing well, AP also is doing well. But within 5 states in south, Kerala is very, very, very small for us. So from the rest 4 states, I think top 2 states are Karnataka and Telangana, and therefore we had planned to open more branches in Telangana and Karnataka. So we have opened 2 branches in Karnataka, that is Bangalore, and 2 branches in Hyderabad. 3 in Hyderabad. Okay. So our focus would be on the states which can give us, more value in terms of business proposition, and therefore we had chosen this. This is the first question that you asked. And see, today I think we feel that for any finance company, be it HFC or NBFC, the starting point is asset quality, which is NPA. So if a company is able to manage the portfolio well, because we do business based out of, it's a leverage business. So the entire business works on borrowed funds, and therefore the company has to be very, very clear in terms of managing the portfolio well. Since we are the lowest in the industry, I think a lot of banks draw that comfort and they lend us at AAA rates, rather sometimes we get the best rate. So I think fortunately this has been continuing a very, very long time, and we feel that as long as we're able to show growth, maintain profitability, and keep portfolio well, keep asset quality stable, I think we will enjoy this recognition from all the banks to be lent at a lower rate.
Okay, got it. So just one question here. So can you also state the percentage of AUM coming from Karnataka and Telangana individually?
Okay, so Karnataka and Telangana would be close to about 42 to 43%.
Okay, and out of this, 30% would be coming from Karnataka, right?
No. See, for example, Karnataka and Telangana would be almost same.
Okay, Got it. Thanks. So over time, I think Karnataka exposure as a percentage of total AUM would have come down because earlier I think it was some 30%.
Yeah. Even though absolute numbers it has gone up, as a share it has come down because other states are now contributing.
Got it. Yeah. And last question. So is there any change in the guidance which we have given on the 10 to 15 branch expansion for 23? Like, since this quarter is 4.
On an annual basis, I think around 12 to 15 branches is the plan. So that there is no change in that guidance.
Got it. And the branches which we will open in this year, in what time frame do we expect them to do a disbursement per branch what we have right now? So would it take like maybe a year or two?
For us, on an average, a branch would take about 8 to 9 months to break even.
And what time would it take to do the disbursement per branch?
Month one.
Okay. Got it. Thanks.
Thank you. We have the next question from the line of Jigar Jani from Edelweiss. Please go ahead.
Yeah, thank you for taking my question. A couple of questions from my end. The first one is on the restructured book. So, can you let me know how much would be still in moratorium and how much and when would it most of the book come out of moratorium? That is the first question. And the second is on credit cost. What would be your guidance for the full year now? Because I presume the provisions that you have taken in this quarter are largely because of the increased standard asset provisioning, if I am not wrong, because we have not had any incremental debt slippages in this quarter.
So credit cost guidance for the whole year would be in the range of 0.12 to 0.14.
Okay, thanks.
This is the maximum cap I'm talking about. In fact, for this quarter it is 0.04.
Regarding the restructured books, we have given.
Answer your question?
So restructured book is in moratorium, is it? The entire book as of now?
Yes. See, we have disclosed that in the city results in the note 5, the outstanding restructured books as on date after the capital accounting is 704.5 crores. And they are coming out of the restructure in a phased manner from December, January, February onwards. And by the end of the financial year, all the loan accounts will be out of the restructure.
Okay, understood. Thank you so much.
Thank you. We have the next question from the line of Ahan Tulshan from Trivantage Capital Limited. Please go ahead.
Hi, thank you for taking my question. I just had one question. If you could speak a little more about the demand trends that you've been noticing, whether across different customer segments and different geographies. If you could talk about that a little bit. Thank you.
Yeah. So we are seeing demand from almost all geographies, but we are going little slow on Kerala and a little slow on Delhi NCR region. But for this, we are seeing demand coming from all other geographies. So in terms of segment, it is very good in affordable. It is very good in non-affordable also, but affordable is slightly higher than non-affordable. And because of the increase in construction cost, in the premium segment, we see slightly less demand, maybe by 5% or so. Otherwise, I think by and large, demand is good across geography, across segment, across products. In terms of profile, self-employed, there is slightly less demand vis-a-vis compared to salaried. This is for Canfin. So we feel that in another 1 or 2 quarters, we will again get back to incremental mix of 70 salaried and 30 self-employed.
Okay, thank you. That's it from me.
Thank you. We have the next question from the line of Umang Shah from Kotak Mahindra AMC. Please go ahead.
Yeah, hi. Thanks for the opportunity. So 2 questions that I have. One is on the provisioning front. So how should we look at it going forward? I mean, do we follow the ECL model, or depending on the balance sheet structure, we'll keep on providing as per IRAC or keep switching between IRAC and ECL?
I think it's a very good question. I think structurally, even though technically it says IRAC or ECL, whichever is higher, but if you see the structure, ECL is always going to be higher compared to IRAC, and therefore going forward, the provisioning would be based on ECL model.
Okay, and basically the credit cost guidance that you have spoken about takes this into consideration.
Yes, exactly.
Okay, perfect. So second question is on how should we look at the equity raise that we had anticipated earlier? So about 1,000 crores is what we were looking at. Any changes in terms of timelines or plans, or we still intend to kind of close it by the end of this fiscal?
Yeah, we are planning to raise capital. This could be now probably before March. Having said that, it may not be the full amount. It may be part of the enabling total quantum. Because as of now, our DR is less than 8, and the capital adequacy is very comfortable. So basically, if we raise, it's going to be capital. It's going to be growth capital. So we have plans. So but we have not decided on the timing and the quantum. Of course, we've been saying this for a long time. That's only because we are ready. We are ready to raise capital. As and when we feel the need, we will raise capital. But it may not be near future, but we are ready in terms of raising capital. And therefore, each time we take enabling approval and be ready.
Understood. All right. Thank you so much, and wish you all the best. Thanks.
Thank you so much.
Thank you. We have the next question from the line of Gaurav Jani from Prabhudas Lilladher. Please go ahead.
Thank you, sir, and congrats on a good quarter. Couple of bookkeeping questions, please. One is, so what was the investment income for the quarter?
Yes, sure. Yeah, we'll tell you. Second question?
Yeah, so I would want the investment income, sir, for Q1 and Q2. That is the first half put together also. Secondly, the tax rate this quarter was higher. So, what would be the reason for that?
So actually, no. In fact, the tax, there's no change in the tax rate. See, we had withdrawn 21 crores from NPA, right? So on that, there was an additional tax. And therefore, if you calculate the total amount of tax, it comes to 30. Actually, there is no change in the tax rate. Only because we withdrew from NPA and now it is sitting in standard, I think that additional thing is adding on to the total tax component.
And the interest from investment income, what we held for SLR and LCR is 41.52 crores as of half year ending 30th September. The same was 19.12 as of June.
Okay, got it. This helps, sir. Secondly, is more of a structural question. So if I have to look at the cost of funds trajectory, the pass on or the pass through was pretty quick in terms of the rise, right? Now I'm sure systemic rates would stabilize at a point in time. So would that mean that the following quarter or the immediate quarter, this cost of funds rise would immediately get arrested, and probably we are looking at a better margin trajectory?
No, this quarter, I think even the interest rate scenario in the market, I think the rates could slightly go up. So we're also prepared for that, and we'll also increase our yields. Just in case if it stabilizes, then we might still increase, but by a small portion, small amount.
No, I meant stabilization in terms of, say, about 2-3 quarters down the line.
Yeah, definitely. As we don't expect interest rate increase by a large extent in next few quarters. So in that sense, it will get stabilized. Even our yield will get fixed.
Sure. Last question, sir, more on the management side. So one is, when is the CEO, CFO, CRO tenure ending, and how would, if that is the case, would it impact the intensity of the business?
I think our present MD is demitting office on 20th of this month. And I think it will be business will be as usual because the team remains and guidance remains for the same.